When it comes to investing in cryptocurrencies like Bitcoin and Ethereum, it's common to think about the massive gains you can get. And hey, as long as Bitcoin continues mooning to all-time highs, I don't blame you. But you should consider the possibilities of paying taxes when you sell your cryptocurrency. And that's where I come in. I've done the research for you, and this will be the only video you need to understand cryptocurrency taxes. Hey, I'm Karan from Life Accounting, the #1 accounting firm for money-saving education and accounting services. Now, there's one thing I need to touch on before we get started. I'm trying to get this video to 100 likes. So if you can help me out by pressing the like button, I appreciate it, and it benefits our channel greatly. Okay, let's dive in. How do cryptocurrency taxes work? In general, if you sell or exchange your cryptocurrency, it is a taxable event. This includes sales or exchanges for fiat, goods, services, or even other cryptocurrencies. Through the eyes of the IRS, cryptocurrency is viewed as a capital asset when sold for profit and subject to capital gains tax. Now, let's unpack that with an example. Stick with me. My fiance, Kayla, really wants an Audi e-tron. Now, why would she want an electric Audi over a Tesla? I don't know, but that's for another video. Now, let's say she wants to buy the Audi e-tron using Bitcoin that she bought for $5,000 that is now worth $60,000. She has a couple of options. First, she could sell her cryptocurrency for dollars and purchase the car in cash. Second, she could purchase the Audi outright with her Bitcoin. And lastly, she could exchange her Bitcoin for another cryptocurrency like Ethereum and then purchase the car outright with Ethereum. So, which option do you think is best? You might have your opinion on what option is the easiest, but all three options will result in a $55,000 capital gain. Now, why is that? Simply put, because she sold her Bitcoin for profit in exchange for something else, that is a capital gain. Remember, whenever you sell or exchange your cryptocurrency for more than what you bought it for, it will be subject to capital gains tax. Now, if you happen to sell or exchange your cryptocurrency for less than what you bought it for, you would have a capital loss. Capital losses are not taxed and may help lower your tax liability by offsetting a portion of your income. Now, let's talk about how much you will pay in cryptocurrency taxes. How much you pay depends on how long you've held it, whether you sold for a loss or gain, and your total yearly income. If you held your cryptocurrency for less than a year, profits are taxed as regular income, which are known as short-term capital gains. If you held your cryptocurrency for more than a year, profits are taxed at long-term capital gains tax rates, which are typically lower than income tax rates. All right, let's talk about payment via cryptocurrency. The truth is this: if you paid for cryptocurrency for work performed, you have to pay taxes on it. In fact, payments made to you in exchange for work is taxed at ordinary income. And ordinary income may be subject to self-employment tax if you're self-employed. Additionally, if you hold the cryptocurrency and then later sell it, profits will be taxed as a capital gain. This also applies to cryptocurrency miners. You see, miners must report all cryptocurrency income derived from mining activities. Let's say you lost your cryptocurrency by hack or by theft. If you are the victim of cryptocurrency scams, loss, or theft, you can report the missing amount as an investment loss. The loss may help you lower your tax liability by once again offsetting a portion of your income. All right, let's get into how to file crypto taxes. The IRS is closely watching investments made in crypto. Near the top of the new Form 1040, there's a question about cryptocurrencies. At any time during 2020, did you receive, sell, send, exchange, or otherwise acquire any financial interest in any virtual currency? If the answer is yes, here are the steps you need to take. The first step is to stay organized. Be able to find and account for every transaction you make. Depending on the cryptocurrency exchange you use, this can be a very easy task as they keep records of all transactions, including purchase price, purchase date, sale amount, and your profit and loss. Additionally, most exchanges will send you a 1099 form before the tax season that will detail all of this information for you. Okay, the second step you should take is to file taxes yourself or hire a professional. You see, some cryptocurrency traders execute hundreds of trades a year, and others execute half a dozen. But no matter how often you trade, if you feel comfortable accounting for the transactions and completing the proper forms, go ahead and file your taxes yourself. If you are not comfortable accounting for and filing cryptocurrency taxes, reach out to a reputable accounting firm like Life Accounting to make sure it's done correctly. Alright, with all this talk about paying taxes, let's talk about the best ways to minimize your tax liability. If you sold cryptocurrency for a profit, here are 3 ways to minimize your tax liability. The first way is to hold cryptocurrency for the long term. You see, the easiest way to save on cryptocurrency taxes is to hold your investment for over a year. When you hold your cryptocurrency for over a year, you can take advantage of long-term capital gains tax rates, which can be substantially lower than the taxes on investments held shorter than a year. That's because long-term capital gains tax rates have a max tax rate of 20%, while short-term capital gains have a max tax rate of 37%. The second thing you can do is to offset your gains with your losses. You see, you can reduce your capital gains on crypto investments by selling other investments at a loss. This is called tax loss harvesting. Now, tax loss harvesting is a good strategy if you know you will be selling an investment for profit or already sold for a profit within the tax year. If you have an underperforming investment within your portfolio, you can sell that investment to minimize your taxes. The good news is that you don't have to limit what you plan to sell at a loss to just cryptocurrency. Any capital asset, such as stocks, can apply. Generally, if you end up with more than $3,000 in losses, you can carry the remainder to future years and tax gains. Now, the third thing you can do to minimize your taxes is to wait till you hit a lower tax bracket. You see, another amazing strategy you can use to lower your tax liability is to sell your cryptocurrency when you know you will end up in a lower tax bracket. That's because the taxes you pay on capital gains are partly based on your income. And if you get time the sale of your investments during the period which you will have lower income, you can reduce your tax liability substantially. Well, there you have it, a complete guide to cryptocurrency taxes. I hope you found this video helpful. If you did, please go ahead and like this video. Our goal is for this video to get 100 likes. Also, don't forget to subscribe to our channel so you don't miss out on other videos we're putting out to help you lower your tax liability. I'm Karan from Life Accounting. Until next time.